Does rebalancing actually help retirees? Interesting. We're going to read this article from a man, Joe Tomlinson, from Advisor Perspectives. And I've cited Joe a couple times on this channel, and I'm a big fan. He's originally from Greenville, Maine, wherever that is. Where's my velociraptors running around like crazy, like they haven't eaten in days, even though they just got done eating. All right, so let's read this. Joe Tomlinson, Dateline 11121. I think he lives in UK now, Joe does. So the subject of rebalancing investment portfolios has generated much discussion as well as confusion among advisors and researchers. A recent example was a 2020 October Advisor Perspectives article by Michael Ennesis. We've had him on here a couple times, actually. I'm a big fan of Michael. Michael's argument, well, let's just read this. Well, I'm not going to read the whole article. We'll just kind of give you the conclusion of his article. I've done a video on this before. The fallacy of rebalancing revisited. So what he's saying is, let's go down to the conclusion, and you can watch my video on that. Conclusion, advising an investor to rebalance is like advising a traveler from Los Angeles to New York to drive rather than take a plane. Because if you take a plane, there's a greater danger of turbulence. However, the risk to life is much greater if you drive because the probability of a car crash is much greater than that of an airplane crash. Many people believe rebalancing pays off because they confuse the past with the future. They think that because the security of an asset had a higher price recently than it has now, it will return to that higher price in the near future. But careful investigation of price patterns reveals that this is not true. The likelihoods of the direction the next price move will take, up or down, as magnitude are independent of the direction or magnitude of the last price move. This mistaken intuition is not valid justification for rebalancing. Rebalancing should be dismissed as nothing but the poorly examined conventional wisdom that it is, the plethora of articles in financial journals filled with largely irrelevant mathematics notwithstanding. The greatest damage done by this myth is that it helps to surround providers of financial advice with the aura of knowing something that they do not know at all. And you can see he's got 118 comments. Oh, Michael, he doesn't pull punches. Awesome. All right. For this analysis, I'll mainly focus on rebalancing versus buy and hold, which is not rebalancing, and I'll use Monte Carlo simulations and provide a measure of benefits and risks. My interest in the subject of rebalancing stemmed from my earlier analysis of asset allocation, where I made the case that modest differences in stock and bond mixes were not an important determinant of retirement results. I could not agree more. And Edison's article talks about that too. Such allocation differences tended to get swamped by variability of year-by-year performance of the underlying asset class, principally stocks. There are considerable overlap between rebalancing and asset allocation, so I wondered if those arguing for and against rebalancing were debating something that does not matter much. Let me pause for just a second, because I completely agree. People say, should I be 70-30 or 60-40? It's just not that big of a deal. It's just not, man. I'm just telling you right now. 60-40 historic has a sliver less volatility. It did a little bit less returns. It's just not that big. Now, if you're going to be 70-30 versus 40-60, yeah. So basically, should I be Wellington or Wellesley? That has a much different historic performance number than Wellington versus Fidelity Balanced Stock Fund, because I think Fidelity Balanced is 70-30 and Wellington's like 65-35. It's just, I hear this all the time. Should I be 60-40 or 70-30? 75-25? Man, it doesn't matter. The real question should be predominantly in stocks or predominantly in bonds. That's what you got to figure it out. All right, so let's keep going back to Tomlinson here. For this example, I use a 35-year retirement that starts with $1 million. I'll assume variable retirement withdrawals based on RMD factors and a target 60-40 stock to bond allocation. I'll use a Monte Carlo generation based on historical stock and bond returns with a downward adjustment. Hey, hold on a second. Finny. Hold on a second. With a downward adjustment to reflect my personal view about future returns. I use a downward adjustment to reflect my personal views about future returns. Hold on just a second. All right, so I'll use bootstrapped annual returns after inflation by randomly selecting 20-year blocks from Ibison's 1926 to 2019 data, and I'm subtracting 4.8% from each of the stock returns generated and 1.9% from bond returns. Wow. The result is the arithmetic real returns will average 0 for bonds and about 4% for stocks, assuming a lower than historical equity premium. The purpose of using bootstrapped historical returns is to capture any correlation between stock and bonds as well as any year-by-year correlation. All right. I use 5,000 Monte Carlo scenarios. All right. The points of the more general limitations is the use of historical data. There's both the statistical significance of the data and the question of whether historical financial relationships will persist in the future. I 100% agree with that. The first analysis compares results for regular periodic rebalancing versus buy and hold for the full 35 years. Rebalancing intervals tested are 1, 3, 6, 12, and never. And let's see. And the remaining savings are rebalanced to a 60-40 stock bond allocation at those intervals. Because I use annual data, it's not possible to rebalance more frequently than annually. Thankfully, you should rebalance more frequently than annually. Withdrawals are based on 1.25 times RMD factors, which produces reasonably level withdrawals over the most of the retirement period. For each of the 5,000 simulations, I calculate the average withdrawal over the 35-year retirement, all right? And the chart below reflects the distribution of those averages. We end up with 5,000 averages arrayed into percentiles, and the overall average of the 5,000 averages displayed as well. Whew. All right, so we got 1 year, 3 year, 5 year, 6, 12. Okay, good. So this is, they rebalance every year, every 3 years, every 6, every 12, never. 60% stock allocation. The average is about, what's that, 26,000 here on the negative to 48,000 on the positive. That's never rebalancing. So you can see it's wider. So you can see it kind of gets wider as it goes forward, if that makes sense. What are you doing, Pablo? What we see here is akin to the charts in my article mentioned earlier on asset allocation. Differences in average outcomes are tiny compared to the range of potential outcomes. Since the ranges are for the 25th to 75th percentile, they only contain half the potential outcomes. The full range of possibilities is much larger. Okay, so this is the range from the 25th to 75th percentile. I got you, okay. So he's not using the top 25th percentile up here or the bottom 25th percentile down there. Okay, gotcha. That makes sense. In terms of a discussion with a client, it goes something like this. If we rebalance to 60-40 every year, I expect your withdrawals to average $38,000 a year right there. So that's $38,000 a year on 60-40, rebalance it every year. Let's see. With a 50% probability of falling between 27,000 and 46,000, an equal chance the range could be even wider. If we just let the portfolio run and never rebalance, things barely change. The average moves up to 39,300, which is only $1,000 more without rebalancing, and the range widens from 26,000 to 48,000. So just, I mean, it's literally that's minuscule change in the 25th to 75th percentile. However, there's a risk side that may change the discussion somewhat. In the chart below, I show the comparison based on two risk measures. Here I displayed two downside measures. The 5% average, for 5 percentile average withdrawals portray a worst case average akin to the 25th and 75th percentile shown previously. Okay, so 5% average withdrawals. So here, never rebalance since 20,400. Rebalancing every year is only 21,000. That's $800 difference. Whoop-de flippin' do, man. 5% annual withdrawal change minus 9,500. It's a little bit more there. Anyway, let's keep going. That's just not that big of a deal. The withdrawal change column portrays the expected worst case year-to-year change in withdrawals. These two measures can be thought of as a layman's utility analysis. A bad outcome would be low withdrawals that are volatile from year to year. There's a slight deterioration in the 5th percentile as we go into the direction of buy and hold, and more adverse change in year-over-year volatility. Having these downside risk measures might give some pause to going for the highest expected withdrawals while not rebalancing. So basically, they're saying, look, the 5th percentile, you're $12,000 poorer if you never rebalance. We're here, you're only $9,500 poorer if you rebalance every year. I just not sure that's worth it, but whatever. The result for both charts reflect underlying changes in stock-bond mixes. Since expected returns are higher for stocks than bonds, without rebalancing, one would expect the stock allocation to increase over the course of retirement. Rebalancing, if any, resets the allocation to 60-40, and with annual rebalancing, this example, the allocation remains at 60-40 throughout all simulated retirements. For example, the rebalancing of 6 years intervals, the average stock allocation is 61%, which is only slightly off the 60% target, which explains why we don't see much in terms of different varying rebalancing intervals. Percentage band rebalancing. Okay, rather than rebalance at fixed intervals, another approach involves rebalancing only when the asset drifts by a given percentage. So in this case, 5% the charts below. Okay, gotcha. So he's saying, well, if we the stocks essentially go from 60-40 to 55-65. Okay, so basically, if you got a 5% range for stocks versus bonds, it's no longer 60-40, it's 55-45 or something like that. Again, hardly any change whatsoever. That's interesting. Average rebalancing interval. All right, here's this downside measure. 5th percentile. I mean, just not. Look at that average rebalancing interval. All right, so here they're only rebalancing. If you wait for the 5% band, you're only doing every 3.2 years. If you wait for a 10% band, you're doing every 7.7 years on average with 20% band. So you start off 60-40. Now we're at 40-60, or 40-60. You're only going to rebalance once every 31 years. That's crazy. That's nuts, man. For example, that's nuts. At the beginning of this article, I speculated that rebalancing may not matter that much. After reviewing the evidence, this is indeed the case. The choice of rebalancing does not guarantee retirement success nor a plan doomed to favor. Getting more specifics, loosening rebalance to a wider intervals or bands increases upside measures such as average withdrawals slightly, with a slight deterioration in the downside. But the rebalancing effects get swamped by the investment return variability. As for the risk measures, the year-to-year volatility of withdrawals is more sensitive than 5% than the 5th percentile of average withdrawals. As for practical implementation, the above results don't make a case for never rebalancing. They support infrequent rebalancing, such as a 10% band. Again, if you did a 10% band, you rebalance every 7.5 years or so, most likely. Below are some comments relative to okay, gotcha. So he uses some comments that other people have made before. All right, this could be the diversification bonus. Yeah, all right, let's just see real quick. Raising equity sequence return. Okay, cool. I did not study high frequency rebalancing such as daily, weekly, or monthly. Some research such as this Vanguard study have demonstrated little, if any, value to be gained from such high frequency trading strategies. Man, let's see what kind of comments we got. See if my man Edison said posted something. Let me see my dogs real quick. Let's see here. I think the challenge with academic type studies is that they're not reality. We are working with real people of real values, but each person. Okay. I do appreciate the academic perspective, utility of these types of articles. The conclusions are useful in some ways, but have to be applied in the real world. This year, we rebalanced every qualified portfolio on March 23rd and did it again on June 15th. We have not rebalanced then. During the Great Recession, we did mass rebalancing 3 separate times. So what we rebalance when there are extreme market distortions. So what's an extreme market distortion? They have, that's a gut feeling. I don't like that at all. How much do you think that it makes little difference results due to the fact that precision is less consequence than being approximately right, particularly when portfolios are placed under stress by the demands of withdrawals? How much do you think it makes the little difference result is due to the fact that precision is of less consequence than being approximate? I don't even know what that means. All right, that doesn't make a sense. Bill Bangin, thanks to well-written articles. My man Bill Bangin, 4% rule guy. My research tends to indicate that there's a beneficial effect from rebalancing withdrawal accounts that is not large, adding perhaps 1/4 of a point to the initial withdrawal rate for rebalancing about every 5 years. Perhaps the different outcomes between my research and yours is purely methodologically. I needed a downside. Is interesting about the 5-year rebalancing. I ran an experiment this morning that is somewhat similar to what you have done. I ran 4% fixed withdrawal rates for the 30. Gotcha. I needed a downside measure to compare results, and since all rebalancing intervals produce 100% success, I chose a 5th percentile bequest as a measure, and here are the results. 7-year rebalancing, 137,000. 5-year, that's weird. If they rebalance every 5 years, they're leaving significantly more. Like your testing, these do best at 5-year rebalancing. This is perhaps this is best at catching the wave. Yeah. There we get my man Larry. All right, so with that said, the reason to rebalance is to make sure you don't allow the market to dictate how much risk you are taking, causing you to take more risk than you have. All right. Well, I mean, I don't. Okay, so he's going back to the emotional status of. He's saying basically investors are going to have too much. They won't be able to sleep at night because they have a 70-30 portfolio over 60-40 portfolio. I don't buy that for 2 seconds flat. Yeah, that goes back to what I always say. during the GFC, global financial crisis, S&P was down 54%. Top to bottom. Wellington was down 37. Were you sitting there thinking, man, I'm glad I got the Wellington. I'm only down 37%. Yes, I'm down more than a third of my capital, but man, that's great. No, no one's doing that. Everyone's freaking out, man. Hell, even the Wells Lee was down with 20%. Let's see, who else we got? I want to see. The only logical thing to do is rebalance daily if there are no freak. Oh, good. Do not rebalance daily, my friends. All right. Ray, we got Larry. We got this guy. All right. So anyway, all right. Here's this guy again. All right. So anyway, there you go. I don't think rebalancing is that big of a deal. Again, I think you have to determine do you want to be, predominantly stocks or predominantly bonds. And then every year you can say, I don't want to be predominantly stocks, but go from 70-30 to 60-40. It's just not worth the effort. When do you do it? You do it when you feel like it? No, let's not do that. Let's just choose to say this year I'm going to be 70-30. Next year, I maybe don't feel like it'll be 70-30. Maybe next year it'll be 40-60. But don't go 70-30 to 65-35. Don't make any sense. Love to hear your thoughts. All right, we'll see you.